Are you a beginner seeking a hassle-free and low-effort approach to building long-term wealth and financial security? Your gateway to low-cost passive income investments is finally here. Discover the power of index funds, investment vehicles that provide broad market exposure and diversification, all at a low cost. Hello, this is Samuel Farron, and you are listening to Index Funds, a beginner's guide to build wealth through diversified ETFs and low-cost passive investments for long-term financial security with minimum time and effort. Provided to you by United Audiobooks. I hope you enjoy my audiobook. Now, let us begin. Introduction. Learn to invest in index funds if you're searching for a nice, passive approach to growing your money. With so many investment alternatives accessible today, it can be difficult for beginners to know where to begin. Achieving your financial goals depends on selecting the appropriate investment instrument. However, it can also be a challenging and perplexing procedure. At this point, index funds come in handy. These funds provide a quick and efficient approach to making stock market investments. It can be tiresome, time-consuming, and entirely perplexing to invest. And if you're buying individual equities, I advise selecting between 10 and 30 different ones. That shouldn't be a problem if you know what you're doing and have the time. However, most of us do not have that much time to study our investments, which also involves time to purchase, sell, and virtually continuously rebalance. So, investing in index funds becomes relevant in this situation. Index funds can provide rapid diversification and a passive option to invest in a wide range of industries if you prefer a more streamlined strategy. You only need one fund. You can reclaim time with a passively managed investment to concentrate on your family, job, or side business. However, the simplicity of index fund investing is its strongest feature. Index funds are open to all investors. You can hardly make a mistake. Index funds allow you to achieve the same potential returns with additional guardrails, as many people aren't comfortable choosing and managing individual equities. Index funds also eliminate the emotion associated with buying and selling stocks during market ups and downs, as we have seen for the past few months. Index funds are often promoted as one of the most popular ways to achieve FIRE, financial independence, retire early, and are supported by billionaire Warren Buffett. Index funds are a form of investment instrument, like an exchange-traded fund, ETF, or mutual fund, that aims to provide outcomes comparable to those on particular indices, thus the name, such as the S&P 500. Here's information on investing in index funds if you wish to follow suit. Introduction to index funds and passive investing. The performance of a standard market index, like the S&P 500 stock index, is what an index fund aims to replicate. Mutual funds, or ETFs, exchange-traded funds, that track indexes can be purchased by investors using a brokerage or retirement account. Index funds have become popular for individual investors in recent years due to their simplicity and low expenses. Without having to incur the expense and risk of purchasing and selling individual stocks, an investor can try to mimic the returns of the broader stock market by using a broad market index fund. It serves as a practical means of investing and gaining market exposure. However, index funds can operate in various ways, and purchasing and maintaining index funds can be expensive. What are index funds? An investment fund, known as an index fund, tracks a certain group of assets known as an index. Stocks, bonds, and other assets, including commodities like gold, may be included in the index. Index funds are investment funds that track benchmark indexes like the S&P 500 or the NASDAQ 100. When you invest money in an index fund, that money is used to acquire shares of all the businesses that comprise that index, giving you a portfolio that is more diverse than one you would have if you had purchased individual stocks. Use the S&P 500 as an illustration. One of the important indexes used to monitor the performance of the 500 largest U.S. corporations is the S&P 500. Your investments correlate to the performance of many companies when you invest in an S&P 500 fund, one of the most well-liked. Index funds have a lower risk than individual stock ownership since they are naturally diversified and aim to reflect the identical holdings of any index they track. Market indexes often have a solid history. Although the S&P 500 swings, historically, it has provided investors with annual returns of close to 10% on average. Always keep in mind that future returns are not insured. Since the funds mimic a specific index investors don't need to monitor their stocks and bonds investments as closely as actively. This distinguishes index funds from mutual funds and is why they are called passive investments. Fund managers actively manage your assets in mutual funds. With mutual funds, the goal is to outperform the market, whereas with index funds, the objective is merely to mirror the market's performance. Since daily human management is not necessary for index funds, they have lower management costs, also known as expense ratios, than mutual funds. By choosing an index fund over a mutual fund, you can save more money on fees over the long run, enabling you to increase your earnings. Regularly investing in an S&P 500 index fund, a process known as dollar cost averaging, and watching your money grow over time is a common option for many investors with a long investment timeline. Why choose index funds for building wealth? Comparing index funds to other stock funds, their relatively low risk is their key advantage. This is because there isn't a fund manager making judgments about investments. The market will entirely determine your payouts. Index funds also have the benefit of being naturally diversified. This is so that they can represent many industries inside an index. Sector concentration may occur even in actively managed, diversified equities funds, depending on the fund manager's choices. However, the weightage of the equities in index funds will vary by industry. Thus, sector concentration will not harm your portfolio. The third benefit is the possibility of strong returns from index funds over a longer time horizon. If you look at them, the Nifty and the Sensex have shown positive returns over the previous 10 years. Investors have received returns from the Sensex of 63.07% over 5 years and 103.5% over 10. Over the last 5 and 10 years, Nifty has returned 57.43% and 97.75%, respectively. Therefore, investing in index funds over the long term could yield positive returns. The minimal costs that index funds have to pay are another major benefit. There is a low expense ratio for index funds. Since the fund manager actively oversees the portfolio and executes securities trades, actively managed funds have higher expenses. An actively managed fund has greater transaction expenses. You can buy stock without spending much money using a low-cost index fund. Additionally, the returns you receive from the index fund will be larger due to the reduced expense ratio. Another benefit of index funds is easy tracking. When investing in an index fund, you don't need to consider factors like the fund manager's experience or alpha WTC. You can put money into an index fund if the tracking error is minimal. The fund can be followed simply by monitoring the stock market. What are the disadvantages of index funds? The lack of flexibility with index funds is their biggest drawback. When there is a market downturn, fund managers of index funds are prohibited from investing in further equities. Therefore, investing in equities other than those in the index will not be able to limit the losses. Actively managed funds may decide to invest in equities with various market capitalizations, particularly when the markets are erratic. This raises returns while lowering losses. Another significant drawback is that the index funds cannot outperform market returns. They will either offer returns on par with or somewhat below the market. You must invest in actively managed mutual funds if you want returns to exceed the market's expectations. Key similarities and differences between ETFs and index funds. Exchange-traded funds, ETFs, and index funds are excellent wealth-building vehicles performing well in various investment circumstances. However, it's crucial to remember that index funds are often ETFs and that index funds are virtually always ETFs. Both index funds and ETFs can be used as set it and forget it investments because they are often low cost and passively managed. Along with other features that suit the typical investor, both investment vehicles can provide built-in diversity. Here, we'll contrast these two investment options to make it easier to decide which, or both, are best for you. ETFs and index funds can perform many of the same functions for the client and are relatively comparable. Let's examine their points in common. Diversification. One of their main advantages is the ease with which index funds and ETFs make it possible to diversify your portfolio. For instance, total stock market funds monitor the performance of every publicly traded firm in the United States, which means that they currently monitor nearly 4,000 U.S. corporations. Both the VTSAX and VTI index funds from Vanguard track the same index, while the former is a mutual fund and the latter is an ETF. Low costs. The fees for index funds and ETFs are reasonable, particularly compared to actively managed funds. Since many ETFs follow an index, costs are kept to a minimum. Index funds have low personnel expenses since they only adjust depending on changes to the index, which is a passive strategy. In 2022, index stock mutual funds had an average fee ratio of 0.05%, according to the most recent report from the Investment Company Institute. This figure was 0.16% for equities ETFs. On the contrary, actively managed mutual funds and ETFs had average fees in 2022 of 0.66% and 0.68%, respectively. Investing without effort. Most ETFs and index funds only try to duplicate an index of equities or other assets. They don't actively trade and strive to outperform the market. Instead, they aim to replicate the index and match its long-term returns. Additionally, investors might use index funds and ETFs as passive investment techniques. For instance, you might be able to invest through payroll deductions if you have access to an employer-sponsored retirement plan. Your portfolio will require little to no ongoing upkeep if you invest a fixed percentage of your paycheck into index funds each pay period. The same holds if you finance a brokerage account with investments in ETFs or index funds. For instance, most brokers provide you the choice to invest automatically when you purchase S&P 500 index funds. Outstanding long-term performance. The excellent long-term performance of index funds and ETFs is another advantage. A stock picker or active fund manager can occasionally execute a good transaction, but few can constantly outperform the market over an extended period. Most active fund managers fall short of beating or even meeting their benchmark over the long term. On the other hand, index funds and ETFs offer a more reliable performance over the long term. For instance, the S&P 500 has historically generated average returns of around 10% annually. Due to their vast diversification, index funds and ETFs are wise long-term investments. Key differences between ETFs and index funds. Investors need to know the key differences between ETFs and index funds. Where to purchase. There is a significant probability that you won't have ETFs as an investment option if you contribute to a 401k or 403b through your workplace, and instead will have index mutual funds as a choice. Opening an IRA, Roth IRA, or a taxable brokerage account is normally advisable if you wish to purchase ETFs. Depending on where you open these accounts, you can access a considerably wider range of funds, including many different mutual funds and ETFs. Ultimately, you have the most possibilities for purchasing index funds through internet brokers. The big brokers provide all of the popular index fund kinds. Investment requirements. The minimal initial investment varies based on the type of index fund. For instance, investment minimums for mutual funds can be a deterrent for some investors. In the past, the minimum investment in the Vanguard VTSAX was $10,000. Since then, the minimum has been lowered to $3,000, which is much better but still excludes certain people who don't always have that much money. You can often buy just one share of an ETF when you have an account with an online broker. Even better, several internet brokers now provide the option to trade fractional shares, You can invest exactly how much you want with these fractional shares since, in some situations, you can purchase as little as 1/100,000th of a share. Trading charges. Mutual funds and ETFs have varying trading fee structures. When working with big brokers, trading commissions for stocks and ETFs are practically non-existent. However, load fees, a type of sales commission, and substantial trading commissions may be associated with index mutual funds. ETFs don't charge load fees up front or at the close. The lesson here is to consider all of the fees since trading costs may counterbalance even if a mutual fund has a lower expense ratio than a similar ETF. Tax planning. Regarding taxes, ETFs are the best option if you often purchase and sell. Capital gains taxes are only owed by the seller when shares of an ETF are sold. Because you sell these shares to fund management, this differs from index mutual funds. All investors who have shares in the fund receive a portion of any profits made if the fund manager sells the underlying assets for a profit. ETFs versus index funds. Which is better? It's challenging to say whether an index fund or ETF is superior because the answer relies on the funds under discussion and your investment objectives. Many index funds are available as ETFs, which offer 24-hour trading and extremely low fees. The investment minimums for index mutual funds typically range from a few $1,000s, and you can only buy and sell at the close of each trading day. But it's vital to remember that mutual funds and ETFs are only tools for investing in assets like stocks and bonds. They're not investments in and of themselves. As long as the expenses for each fund are comparable, you should experience similar performance over longer periods if you invest in a mutual fund and an ETF that both track the same index and contain the same underlying stocks. Whether you invest in an index fund or an ETF, you invest in your future. The differences between the two are typically negligible. Index funds and ETFs are often, but not always, interchangeable. The decision to start investing is more significant than the one you select. Doing this benefits you from reduced costs, diversification, and a long-term investment. The power of diversification. The market is volatile due to political unrest, trade tensions, and slowing global growth. Even though the future is unpredictable, diversification can help manage risk and lessen the effects of a significant market disruption. A turbulent market, rising trade tensions, political unpredictability, and slowing global growth have not made the past few months easy for investors. Over the upcoming months, Morgan Stanley research anticipates that volatility will remain high. If you are a long-term investor, volatility is nothing to be alarmed about, but it is crucial to take practical measures to manage it. Diversification is your best option in terms of tools. What does investment diversification mean? Diversification spreads investments among asset classes, industries, and geographical areas to lower an investment portfolio's overall risk. By holding a mix of investments, the assumption is that the weak performance of any one investment may be counterbalanced by the stronger performance of another, resulting in a more consistent overall return. Thus, diversification attempts to incorporate assets with low correlations to one another. Diversification is the most crucial element of achieving long-term financial goals while avoiding risk, according to most investing specialists, even though it does not guarantee against loss. Here, we examine why and how to diversify your portfolio. Understanding diversification in investing. Let's imagine you solely own airline stocks in your investment portfolio. After industry-specific adverse news, such as an ongoing pilot strike that may eventually cause aircraft cancellations, share prices of all those stocks may fall simultaneously. This implies that the value of your portfolio will decrease noticeably. A few railway stocks can offset these equities, ensuring that just a portion of your portfolio is impacted. There is a strong likelihood that railroad stock values will increase as passengers seek out alternative forms of transportation. At the core of diversification is the deliberate process of balancing your portfolio among various investments. When you diversify, You adopt a defensive stance as opposed to trying to optimize your returns by investing in the most successful businesses. The U.S. Securities and Exchange Commission actively promotes the diversification policy. The power of diversification. Diversification is based on the notion that different assets behave differently, even under the same circumstances. A portfolio can be more resilient to shifting market and economic situations by carefully combining assets with various traits. Asset allocation, or how your investments are split among different asset classes like equities, fixed income, and cash, is the greatest way to achieve diversification. According to academic studies, the asset allocation strategy substantially impacts how well an investment portfolio performs in the long run. Additionally, you can reduce the risk of your portfolio by investing across various properly picked asset classes instead of holding just one, such as Australian shares. Keep in mind that risk management is just as crucial as increasing profits. To achieve your financial objectives, it's crucial to have a long-term strategic asset allocation (SAA) framework and short-term tactical asset allocation (TAA) views that consider current market events. The importance of diversifying your investments. By diversifying your investments, you can increase profits while lowering risk. What does that signify, though? How can you invest in a way that safeguards your assets and maximizes your chances of profiting? Is it possible to diversify too much? Let's start with the fundamentals and examine why investing across various asset types is important. One of the essential components of a solid investment strategy is diversification. By diversifying your investments across several asset classes, you raise the possibility that some will perform well even if others don't. Let's start with an example to illustrate better why diversification might be advantageous. Assume you have investments in two businesses, one of which makes bicycles and the other organic baby food. Since both companies are doing well, you buy shares by spending $10,000. Over time, though, things start to go wrong for the baby food firm. While young people's interest in riding is rising, the market for organic baby food is falling. The rise in bike popularity reduces the baby food company's losses. Diversification helps in risk management and asset protection. Spread out your assets rather than putting all your money in one industry or location to increase your safety if something goes wrong. You would likely notice asset diversification if you looked at several portfolios. Most investors don't invest all of their capital in one industry or type of security. As an alternative, they usually spread it throughout several investments and asset classes. Why? Because doing so can lower the risk and safeguard their investments. The key advantage of diversification is that it lowers the volatility of your portfolio. In other words, if one investment loses value, another one might rise in value at the same time, ensuring that total performance over time, even if just barely, remains positive. As an illustration, if you invested 100% of your portfolio in stocks, a year's worth of growth would vanish overnight if the stock market dropped 10%, which is a fairly regular occurrence. While there will always be losses due to bad decisions made by investors or companies, or both, diversification reduces this risk because when some assets fall in value, others rise. Therefore, even though there will always be losses due to some bad decisions made by investors or companies, or both, when properly diversified, gains will likely still offset those losses on average across all investments equally, meaning they won't completely kill our chances at prosperity. Avoiding trying to time the market is the most crucial thing you can do while investing. Your returns will likely suffer if you attempt to enter or exit at the perfect time, which is difficult. Even experts with access to various sophisticated algorithms struggle to execute it consistently. Instead of trying to predict when an up period will start and then frantically trying to buy additional shares before prices begin to rise once more, it may be preferable to concentrate on making sure that you have something invested when one does. A diversified portfolio can help to ensure this because even if one industry performs poorly, another may be performing well enough for overall gains. If one asset class loses value relative to others, others may have gained it. And if one company files for bankruptcy, as some will unavoidably do, there are other companies whose stock price is unaffected by this event. Investing in various investment vehicles is crucial to minimize risk and maximize potential. By spreading your money out and reducing your exposure to any one investment or industry, diversification can help lower risk. For instance, if your whole portfolio consists of stock investments and the stock market crashes, it might completely wipe away the value of your holdings. However, suppose you have a varied portfolio that includes bonds, real estate assets, stocks, and perhaps even some cash. In that case, it may be less probable that all of those investments will experience a loss of value at the same time when the market declines. Since timing the market is impossible and there are no assurances as to how it will move, it is advisable to spread out your investments over time. This way, when an up phase starts, money will be invested while you wait for other people's growth periods, or even a flat period, to resume. Diversification should be understood by all investors. By dispersing your investments over a variety of asset classes and spreading your portfolio, you can minimize the chance of losing money on a single product or market area. You'll also increase the likelihood that some of your investments will succeed even if others don't. How diversification lowers volatility and manages risk. Diversification aims to improve rewards over a long period while lowering total risks. This is because all assets react differently across various periods. Diversification is a tried and true method to lower investment risk. Don't put all of your eggs in one basket is a saying that is synonymous with diversification in the business sector. To put it simply, diversification is the act of distributing investments across various asset baskets to lower investment risks. A diversified portfolio includes components from many investment classes, such as equity, fixed income, real estate, gold, and other commodities. These components help the portfolio provide above-average long-term returns. The requirement for portfolio diversification is heightened for several reasons, including but not restricted to the macro or microeconomic environment and business variables. Diversifying your portfolio is a rigorous process. Therefore, mindless diversification is useless. The overall consequence of diversification should be stable performance and smoother returns that never move up or down too quickly, putting investors at ease due to the lower volatility. Principal asset classes. Diversifying's 4 basic asset groups are equity, fixed income, real estate, and alternative investments. Using mutual funds to diversify is a wise move for individual investors. Mutual funds are excellent investment options that offer cost-effective and highly transparent alternatives. Given the abundance of possibilities available in the mutual fund industry, employing MFs is the only way to build a full portfolio. Different kinds of assets, including bonds and stocks, typically have a negative connection with one another. Therefore, a mix of asset types is good for the benefits of diversification. It is best to have a diverse portfolio in both sectors since unfavorable changes in one are probably countered by positive developments in the other. While investing in fixed income may tend to lower overall returns for a portfolio, it may also lower overall risk and volatility. One might also take a chance and invest in gold, which acts as a solid hedge against the depreciation of the US dollar. Various sectors. Second, it's critical to diversify the portfolio across several industries. As a result, their vulnerability to a single economic shock will be reduced, and their ability to rebalance their portfolio will be increased. An investor wishing to reduce their exposure to a particular industry may find diversifying by industry and size advantageous. It could be volatile, energy, industrials, defensive, utilities, healthcare, or cyclical, financial services, real estate. By cramming the portfolio with concentrated exposures in companies from one industry or market, you will never get the benefits of diversity. Investments in many global markets lessen the likelihood that the portfolio will be substantially impacted by unforeseen natural disasters or a change in the political climate in a particular market. It's vital to remember that the better an investment is, the more uncorrelated it is. They may weather the market differently in this way. A portfolio needs a diverse range of industries since the risks businesses face within each area are similar. Portfolios should vary by industry, size, and geography to lower company-specific risk. An investor may be able to control risk and lessen the volatility of an asset's price swings by diversifying their holdings. Although your portfolio may be well diversified, the risk may never be avoided. Diversifying your portfolio's holdings in today's unpredictable climate, volatile market, and short economic cycles is crucial. Most essential, getting expert assistance is advised while building a portfolio. A financial expert may offer advice on methodically diversifying the portfolio, considering long-term profits, and reducing short and long-term risks. With the assistance of a specialist, you may work out your personal risk tolerance and customize your portfolio to that level. Ultimately, it all comes down to whether you want liquidity or are prepared to wait it out over the long haul. This will have an impact on the organization of your investments. Every investor has a unique risk tolerance, investing objectives, and financial capabilities. This has a significant impact on determining the mix of investments. Last but not least, evidence-based approaches that rely on information and logic rather than emotion often succeed. As mentioned, not all asset classes, industries, or markets respond to diversification similarly. Nevertheless, it is a crucial instrument for enhancing long-term, risk-adjusted returns. I hope you are enjoying my audiobook so far. It would be a pleasure if you could let me know how you are feeling about this audiobook in the comments section below. We would greatly appreciate it if you could also like this video and subscribe to United Audiobooks to have access to more best-selling audiobooks in the future. Also, please, if you are interested in getting more free audiobooks, please click the first link in the description below. Now, let us carry on with the next chapter. Exploring different types of index funds. In 1976, John Jack Bogle made index funds available to individual investors. The Vanguard 500 index vehicle was a vehicle that tracked the S&P 500 index. The main goal was to obtain broad diversification without spending much on individual securities purchases or incurring hefty fees from actively managed mutual funds. But since 1976, index funds have changed significantly. Additionally, using index funds, investors can increase their exposure to specific asset classes, markets, sectors, or investment philosophies. This chapter will examine 9 different types of index funds that have developed over time. We'll look at how they differ in terms of construction and how they can work with different risk profiles in investor portfolios. 1. Broad market index funds. This type of index fund tries to replicate a broad swath of the investable stock market. Since it exposes investors to equities from various market capitalization and industries, an index fund that tracks the Nifty 500 index, for example, is a broad market index fund. The Motilal Oswal Nifty 500 fund is one example. Another example is the 750 equities from large cap, mid cap, small cap, and even micro cap enterprises that will be available to investors through the Navi Total Market Index Fund. In addition, there are numerous index funds worldwide. A sizable portion of the index fund investments in the U.S. are made in broad market funds such as the Wilshire 5000 Total Market Index Fund, the Russell 3000 ETF, and the Vanguard Total Stock Market Index Fund. In conclusion, broad market index funds merely attempt to replicate the overall stock market performance. As a result, they provide an excellent option for long-term investors. However, the holdings will always overlap if you invest in a broad market index and additional index funds. It is impossible to prevent this overlap. However, as long as you meticulously analyze your overall asset allocation among large, mid, and small cap companies, regardless of whether you invest via mutual funds or stocks, you shouldn't be overly concerned with the overlap. 2. Market capitalization index funds. Size is important. It is an adage ingrained in our culture, especially regarding investing. The market capitalization of the companies is used to weigh the bulk of the various indexes. For instance, market cap-weighted indexes include the Nifty 50, the Sensex, the Nifty Next 50, the Nifty Midcap 150, the Nifty Smallcap 250, and the Nifty 200. Stocks often experience ups and downs. Most stocks are either overvalued or undervalued at any one time in that framework. In other words, a market cap index weighs a stock more heavily if it is overvalued and less heavily if it is undervalued. Therefore, every new dollar in an index fund fuels the already present distortion. As a result, certain equities end up with disproportionately higher prices than others. Another way to look at it is that by driving up stock prices, index funds are somewhat to blame for prolonged bull runs. Nevertheless, a swift and significant market-wide correction inevitably results when the costly equities reach an unsustainable price level. Again, short-term volatility shouldn't be a huge concern if you are a long-term investor. 3. Equal weight index funds. Opting for an equal weight index is one strategy to combat the over- and underweightedness of a market cap-weighted index. Simply put, an equal weight index is one in which each stock has the same weight. Let's use the Nifty 50 index as an example of the index being considered. In such an instance, the conceptual weight for every 50 companies is 2%. Put another way, picture an equal weight index as a perfectly balanced ship and steer clear of storms brought on by price momentum or valuation biases. An equal weight index is typically more value-oriented. Also, compared to a market-weighted index, an equal weight index is unquestionably far more diverse. 4. Smart beta or factor-based index funds. The market capitalization technique is the method of establishing an index that is most often used. It need not be the sole option, though. Additional characteristics, such as the P/E ratio, dividend yield, book value, cash flow, sales, etc., can also be valuable measures for creating an index. These indicators are probably more effective at identifying companies with good valuations for an index portfolio. The computing power of today's computers is far greater, and they can learn from intricate data streams and financial measurements. These discoveries are then grouped into conveniently packaged traits known as factors. Then, these variables are referred to as value, momentum, quality, volatility, etc. Factor-based index funds have just begun to acquire popularity. Even some factor funds may be known to you as smart beta funds under a different name. Now, most new smart beta funds created in the US only include one component. The Edelweiss Nifty 100 Quality 30 Index, for instance, makes use of the quality component. This component is a composite of various variables, including return on equity, ROE, return on capital, operating cash flows, OCF, company debt, etc. The volatility factor, value factor, momentum factor, and other factors are also used by index funds and exchange-traded funds, ETFs. Index funds, which use 2 factors and occasionally 3 factors, are a type of multi-factor fund that mutual fund providers have recently introduced. These multi-factor index funds manage returns, risk, and volatility more effectively to provide a complete investing alternative. 5. Strategy Index Fund. The goal of a strategy index fund is to duplicate strategy indexes, which are created utilizing investment methods and quantitative modeling. For instance, the Nifty Dynamic Asset Allocation Index is one of the available strategic indexes. The 2 indexes that comprise this index series' main components are the Nifty 50 and Short Duration Debt Dynamic PE Index and the Nifty 50 and Short Duration Dynamic PB Index. Assigning weight to each asset class based on its value as determined by the price-to-earnings ratio, PE, or price-to-book ratio, PB, These indexes track several asset classes, primarily equities, and debt. As a result, it may be appropriate for investors who want to reduce their stock allocation when it is too high, and vice versa. 6. Sector-based index funds. ETFs, or funds based on industries, are popular among investors. The goal is to invest in companies operating in the same sector or industry. For instance, each industry has index funds and ETFs, such as banking, technology, healthcare, infrastructure, and consumer. Typically, these sectoral funds serve bigger groups. However, there exist index funds with considerably more restricted and detailed mandates. A PSU bank-only or a private bank-only index fund is an option for investors, whereas a banking sector index fund is focused on the larger banking category. Over the past few months, several launches in this area have been in the U.S. investment business. Additionally, it is a category that has the potential for rapid growth. 7. International index funds. There were merely 3 or 4 passive overseas funds earlier in the year. However, there have been a lot of offerings in the international index fund market over the past 8 months. Several U.S.-specific indexes, including the NYSE FANG Plus Index, the NASDAQ Index, and the S&P 500 Index, are now tracked by funds. Additionally, a few funds track the Hang Seng Index. You can also access a few developed market indexes that function independently or in combination with other funds. Recent indexes' historical performances, particularly those based in the US, have helped to win over Indian investors. This has had the beneficial effect of increasing portfolio diversification. Consider the NYSE FANG Plus Index as an illustration. This index comprises 10 heavily traded internet and technology stocks, such as Apple, Tesla, Facebook, Twitter, and Alibaba, with equal weights. The performance correlation between the NYSE FANG Plus Index and the Nifty 50 Index is the key performance indicator in this case. These two indexes are utterly at odds with one another in terms of performance and the types of businesses and industries they represent due to their small 0.15 correlation. As a result, investing in the FANG Plus Index not only facilitates crucial diversification, but also aids in filling in some of the potential holes in your portfolio. 8. Debt index funds. When you invest in debt products, you run the risk of 2 main things. One is that changes in interest rates cause fluctuations in bond prices. This is what we refer to as the interest rate risk. And secondly, the credit risk, or the likelihood that some bonds will stop paying because the bond issuer has stopped making payments. In India, debt-based index funds are not among the most well-liked products. However, debt index funds, such as target maturity index funds, can be very helpful in reducing the credit and interest rate risk in your portfolio. Take the just-released ICICI Prudential PSU Bond plus SDL 4060 Index Fund, September 2027, for instance. This passively managed strategy replicates a unique index of 8 AAA-rated PSU bonds and 20 state development loans in a 40-60 ratio. The maturity date for this debt index fund is the 30th of September 2027, despite the plan being open-ended. Therefore, interest rate risk is eliminated if an investor holds their investment until maturity. The credit risk is also non-existent because the investments flow into PSU bonds and AAA securities. Now that numerous investment firms are introducing schemes in this category, debt index instruments are becoming increasingly popular. For instance, the investment philosophy of ICICI Prudential PSU Bond plus SDL 4060 Index Fund, September 2027, is comparable to that of Aditya Birla Sun Life Nifty SDL plus PSU Bond September 2026 60/40 Index Fund and Edelweiss Nifty PSU Bond plus SDL Index Fund 2026. The Bharat Bond Index, a low-cost, passively managed investment vehicle that invests in public sector bonds with a AAA rating, is also managed by Edelweiss. IDFC Mutual Fund has a few gilt index products that only invest in government securities. Axis Mutual Fund offers a bond fund, and Nippon India Mutual Fund has many products. 9. Custom index funds. A typical index works on a one-size-fits-all principle. However, when more data processing capacity is made available, it helps pave the way for much greater customization based on what the fund manager wants and what various investor groups are looking for. Custom indices have a role in this situation. Said, custom index funds give institutions and advising companies the freedom to design their collection of passive investing techniques. Imagine the architect providing you with a basic set of blueprints but allowing you to modify the design to meet your unique needs. Custom indexing has now begun to gain traction, although not being widely used. Several international financial institutions are implementing it in light of cutting-edge technologies and zero to minimal commission trading fees. Indian mutual fund providers also have a positive attitude toward creating unique indexes. And in the ensuing 3, 4, or 5 years, these funds will probably become more well-liked. You can refer to it as love, affection, or attraction. However, the fact remains that millions of investors worldwide, including those in India, are interested in passive investment. And since 1976, when the Vanguard Group introduced the first publicly traded index funds have undoubtedly advanced significantly. You can research and invest in many schemes covered in this chapter. But before investing, consider how they might fit into your portfolio. Choosing the right index funds for your portfolio. The case for index investing is easy to understand. At a fraction of the cost of actively managed funds with a comparable concentration, mutual funds and exchange-traded funds, ETFs, that merely seek to duplicate the performance of key indexes typically produce greater long-term performance. Index funds and ETFs accounted for 40% of all investor assets by the end of 2020, up from less than 20% in 2010, as this simple argument has gained popularity. However, picking the best fund can be difficult, especially considering the continuously expanding range of possibilities. Nearly 200 large-cap blend funds were cited by Morningstar in a recent analysis as potential building blocks for a well-diversified portfolio. How, then, do you decide which is best for you? Choose index funds that have the lowest expense ratios. Most index funds and ETFs impose an expense ratio, which is a yearly fee. This small fee covers the fund's operating costs. Yes, there are costs involved in buying and selling the investments that index funds hold, among other things, even if their sole goal is to mimic the performance and makeup of current indexes. Since no line item on your regular fund statements reveals how much the fee costs you, it's not precisely apparent that you're paying an expense ratio. Instead, a portion of the fund's assets is subtracted automatically from your returns. The costs involved with indexing are important. Search for the fund or ETF with the lowest expense ratio after choosing the investment category you want to employ indexing. The Fidelity Zero Total Stock Market Fund, which stays true to its name and charges no fees, is one of the top total stock market index funds. The Vanguard Total Stock Market Fund and Schwab's Total Stock Market Index impose annual cost ratios of 0.03% and 0.04%, respectively. Those extremely low expense ratios can be more advantageous than funds with identical characteristics but charge larger fees over time. Analyze the math. If the expenditure ratio was 0.63% and you invested $10,000 a year for 10 years at an 8% gross return, you would have about $151,000 at the end of the term. You would have more than $156,000 if the expense ratio for a different fund tracking the same index and using the same technique were only 0.04%. The difference, which is solely due to fees, is $5,000. Imagine the potential growth over a 30 or 40-year investment horizon. Don't sweat the ETF versus index fund difference. When looking for products that passively track an underlying index, You might wonder what the difference between an index fund and an ETF is, and, more importantly, whether it matters. The fund's share price volatility distinguishes an index fund from an ETF. You can order an index mutual fund at any time, but the price will be determined by the value of all the underlying assets at the end of the current trading day. Your trade will be completed at the closing price on the next trading day if you place an order after the market has closed, 4 p.m. ET for U.S. exchanges. ETFs are traded like stocks, and their prices fluctuate throughout the trading day. It doesn't matter what kind of fund you choose, as long as it's affordable, provided you can buy and sell an ETF and mutual fund without paying a commission, which is becoming increasingly popular at the finest brokerages. However, if you're starting with your investments, whether in an IRA or traditional taxable account, an ETF might be a more sensible option. Many mutual funds have a $1,000 or more minimum initial investment requirement. However, if you open a brokerage account, you can start investing immediately with just one ETF share, often far less than a fund minimum. Even a tiny portion of an ETF may be enough to get you started. ETFs often benefit from lower expense ratios as well. Sometimes the differences are minute. The expense ratio for the Vanguard Total Stock Market ETF is 0.03%, whereas the fee for the mutual fund counterpart is 0.04%. Sometimes the difference is more than a few hairs. The expense ratio for the iShares S&P 500 Index ETF is 0.09%, while the investor share class of the mutual fund version levies a fee of 0.35%. But one fundamental principle still applies when choosing between mutual funds and ETFs. Go with the one that makes it the least expensive to generate an index. How index funds work best in a portfolio. A retirement or investing portfolio can be used in a variety of ways. You can rely on indexing. Robo-advisors often use ETFs for this strategy. As an alternative, you can combine actively managed funds with index funds. Hawley builds his clients' portfolios using the Core and Explores strategy. The foundation uses low-cost index funds and ETFs, but he also selects some actively managed funds offering more alluring risk-reward potential. Regardless of the strategy you select, the goal is to concentrate indexing in the market segments commonly referred to as being efficient. A market with so much information available and smooth trading that is difficult for active management to outperform. The Active/Passive Barometer report from Morningstar compares the performance of actively managed funds to the average performance of index funds in a given investment category. Less than 1 in 4 active funds outperformed their index counterparts in the 10 years leading up to 2020 across all categories. Indexing was even more effective in the most effective markets. In the 10 years leading up to 2020, just 8.4% of actively managed big-cap blend funds, 9.3% of large-cap growth funds, and 14% of large value funds outperformed their indexing counterparts. Less than 3 of 10 intermediate core bond funds outperformed the category's benchmark funds. Active management has a better market track record when less uniform information is accessible or a less standard trading platform. Over the last 10 years, over 40% of actively managed funds invested in U.S. small and mid-cap growth, high-yield bonds, corporate bonds, real estate, and emerging stock markets have beaten index funds. Building a portfolio with index funds. One fund can be used to create an all-index portfolio if you wish to keep things simple. 2 or 3 funds can do the trick if you want more control over your asset allocation mix. Specify a target date fund. A target date fund can be used in a retirement portfolio. One fund with a year in the title near your 65th birthday will do. You are all done now. Based on your investment time frame, the target date fund handles all the heavy lifting by investing in a mix of bonds and stocks, or ETFs. Numerous target date funds only use inexpensive index funds and index ETFs. Use the 3-fund strategy. Another simple strategy is to set up a 3-fund portfolio that consists of a high-grade U.S. bond index fund, an overseas stock fund, and an index fund that covers the entire stock market. This gives you greater flexibility over your equity to bond ratio, but necessitates more involvement from you than a target date fund would. Setting your investment goals. According to a recent bank rate survey, more than half of American workers claim they are behind on their retirement savings. The ultimate financial objective for many people is retirement, so why do so many people fall short? Failure to establish and maintain specific investment goals over time may be one of the causes. If you don't know what your goals are in the first place, it won't be easy to achieve them. Even though beginning as a new investor can be frightening for some, knowing your top priorities can increase the likelihood that you'll succeed in achieving them. Here are 4 guidelines for setting investment goals. Know what is most important to you. It would help to consider what's essential to you before defining particular investment goals. Do you intend to have children? When do you intend to retire? You can learn more about what is important to you by considering the answers to questions like these. From there, you can begin defining your financial goals, which are any life events for which you'll need to start saving and investing. Retirement, getting married, having kids, and purchasing a home are common investment objectives. The following stages will assist you in setting and achieving your goals. 1. Choose your top priorities. Each person's objectives will vary differently depending on their particular situation. You can direct your savings toward the areas of your life that are most important to you by figuring out your priorities. SMART is a well-known acronym for a goal-setting strategy. This is how it goes. S. Specific. Goals should be specific, outlined, and understandable. M. Measurable goals are easier to track and determine whether you are on track or lagging. A. Achievable. You should be able to accomplish the objectives. R. Realistic. Goals shouldn't be impossible fantasies. T. Time-based. When do you anticipate achieving your goals? 2. Organize your goals based on how far into the future they might extend. After determining your most important goals, dividing them into several time horizons can be useful. This will enable you to choose the investments that will work best with each goal. Short-term goals. Goals that fall under this category are probably things like a trip, a down payment on a car, or other events that will probably happen within the next several years. Medium-term goals. These goals will likely be more substantial and may take longer. Depending on how big you want it to be, this category of goals could include a down payment for a home or wedding. Long-term goals. When people consider saving, retirement is typically the first thing that comes to mind. Retirement is the ultimate long-term objective if you're starting your profession because it will probably take 30 to 40 years from now. If you have little children and are saving for their future college costs, saving for your children's education would also fall under this heading. 3. Select investments that support your goals. It would help if you choose the optimal investments for each goal after determining the time horizon for each one. Since the goals have different periods, using the same investment approach for each won't make sense. The investments that often achieve various goals the best are listed below. Investments for short-term goals. It would help if you focused more on protecting your money than rapidly growing it when investing for events that will occur in a few years or even sooner. Some of the best low-risk investments for short-term goals include money market funds and high-yield savings accounts. Although you won't generate much more money, you can be sure that it will be available when you need it and that you're getting the highest interest rate possible compared to the rates offered by conventional bank savings accounts. Investments for long-term goals. Depending on your total risk tolerance, you might be able to take greater risks for goals that are a little further in the future, such as those that are 3 to 5 years out. Some investors might continue with riskier products like high-yield savings accounts and money market funds. However, for those with higher risk tolerance, investing a small portion of your portfolio in high-quality companies through index funds may allow you to achieve higher returns. You could also accomplish your goals by investing some of your money in dividend-paying companies, but remember that even top-notch equities might lose value. Investing in long-term goals. Long-term goals should be prioritized to allow you to invest with more risk. These goals are those that are longer than 5 years. Retirement is one example of a long-term goal that could be decades away, giving you plenty of time to compensate for potential losses. Because of these factors, equities typically make the best long-term investments in a diverse portfolio. Most individuals find that using an online broker, which enables you to buy various assets, is the easiest way to invest in stocks. You can invest in companies through mutual funds and ETFs, but watch out for hefty fees. Index funds that follow large market indexes like the S&P 500 have traditionally generated yearly returns of around 10%, making them reliable long-term investments. Goals with deadlines can benefit from target date money as well. The year that the goal is expected to be attained is written on the labels for these funds, and they are then invested with that time horizon in mind. For instance, a 2050 target date fund will start investing rather aggressively and progressively change its asset allocation to be more cautious as time passes and the target end date approaches. These can be rational for retirement plans or college savings for children. 4. Regularly do investing goal check-ins. Make sure your investment goals align with your plans by periodically reviewing them. It's common for goals to change. When that happens, you must update your investments. Additionally, as time passes and what were previously medium or long-term goals become shorter term, it is crucial to change your investments. If you intend to retire in a few years, investing your money in equities makes little sense. This routine evaluation can help ensure that your portfolio is correctly matched to your objectives and level of risk tolerance. The first step in reaching your investment goals is to identify them. Consider your short and long-term goals before making an investment decision. Remember to evaluate your goals at least once yearly and modify your portfolio as necessary. Your goals can be achieved by exercising discipline and following your plan. Robo-advisors can be a terrific method for people who would rather have someone else manage their assets to access excellent portfolio management at a far more affordable cost than hiring a traditional financial advisor. You can even obtain features like tax loss harvesting and automatic portfolio rebalancing. Considering your time horizon and risk tolerance. An investor's risk capacity or tolerance can be evaluated using their time horizon. At its core, a time horizon responds to a crucial question: when do you need this money? Example of a time horizon. Almost everyone has the same investing goal, which is to have a comfortable retirement. Imagine you wish to retire a little early, at 65, instead of the typical retirement age, 67. If you're 30 years old in 2023, your temporal horizon includes the 34 years from now to 2057. To accelerate your progress and feel secure enough to quit the workforce in 2057, you'll need to take bigger chances with your assets earlier in your career. It's crucial to understand that you'll need to consider a different time horizon when considering retirement. You won't need the entire sum on the day you retire. Your money might need to last an extra 30 years, depending on your health and the lifespan of your family. Common time horizons. You will consider various investing time horizons at once because you have several goals for your money. It would help to consider the calendar when evaluating your goals, whether saving for a new automobile or preparing to buy a vacation home. These 3 time horizons are typical. Short-term time horizon. A short-term time horizon is the money that you will soon require access to. Your emergency fund, which you can keep in high-yield savings or money market account, is an example of a super short-term goal. If the worst happens tomorrow, you will need your money immediately to cover some bills. Other financial requirements fall into the short-term horizon group, even though they have a little longer horizon. You might want to meet your target before the lease on your rental unit expires in 11 months if you're saving for a down payment on a home. Value loss is unaffordable, but some more growth would undoubtedly be beneficial. Maybe you'll invest it in a short-term certificate of deposit to benefit from increased interest profits. Medium-term time horizon. Depending on how you view your goals, what falls under a medium-term time horizon may change, although these often take place between 5 and 10 years from now. For instance, if you are saving for college for your 9-year-old, you will need to start taking money out for tuition in the next 8 years. Longer lead times allow you to tolerate some risk, but you are more likely to have a mix of investments that limit your exposure to significant losses. You may, for instance, spread your investments among stocks and lower-risk bonds. Long-term time horizon. You are operating on a long-term time horizon when you consider big goals that are further in the future. Retirement is the most obvious illustration of a long-term view for a younger investor. You have decades of labor ahead of you if you are in your 20s or 30s. Your ability to manage the risks of loss in your investing portfolio increases with time. Why it's crucial to understand your time horizon. You must know your time horizon to develop an investment strategy that achieves your goals. A crucial distinction between the return on investment and the return on your investment will depend on the time horizon. Your attention is shifted toward its return since you have a shorter time horizon. You want to be sure you can recoup your initial investment. For instance, if you know you'll need the money in a year, you won't have much time to let it grow and won't have much room to take a chance of losing it. However, if you have a longer time horizon, you'll be considering the typical meaning of ROI, which is a return on investment. You can tolerate greater volatility to pursue larger returns thanks to the luxury of more time. How to determine your time horizon for investing. Knowing when you'll need this money allows you to understand your investing time horizon better. You can estimate how much you would need to save at an average annual return using Bankrate's simple savings calculator. Remember that your investment allocations will change as your time horizon does. You will need to take a more cautious stance when the due date for your money is approaching. For instance, your retirement has a distant future when you are 25. Your initial retirement account withdrawal at age 60 will have a short-term time horizon. Your attention will shift away from growth and toward protecting against losses. Constructing a balanced portfolio with index funds. Building a balanced portfolio is an important task and an art in investing. Your portfolio of investments includes all of your holdings, such as stocks, bonds, mutual funds, and exchange-traded funds in your brokerage, retirement, and other accounts. It would help to have a balanced portfolio to manage market risk and attain your long-term goals. Asset allocation strategies for long-term growth. Asset allocation refers to the variety of investments in a portfolio. Maintaining the proper asset allocation is likely the most crucial choice long-term investors can make. It represents the percentage of stocks, bonds, and cash in any portfolio. The allocation of your assets, specifically, how much of your assets should be in stocks, is the most fundamental decision in investing, according to Jack Bogle, the creator of Vanguard. How many bonds should you own? How much cash should you keep on hand? Bonds and stocks each have different benefits and drawbacks. According to history, stocks typically have a better rate of return than bonds over the long term. Stocks have experienced an average annual return of over twice that of bonds since 1926. Additionally, stocks have higher volatility. A portfolio's volatility is reduced with bonds, but the projected returns are lowered. Given this dynamic, choosing between stock and bond allocation may seem challenging. This chapter will examine asset allocation models from two different angles. First, we will look at the stock-to-bond allocation and how it affects the volatility and returns of a portfolio. Next, we'll take a closer look at some sample investment portfolios that any investor can use to put their finalized asset allocation into practice. A plan for asset allocation includes more than just stocks and bonds, so keep that in mind. For instance, while allocating equities, one may consider factors like market capitalization, geography, U.S. versus worldwide stocks, and alternatives, such as real estate and commodities. Some of these asset classes will be considered in the following model portfolios. Basic asset allocation models. As was already mentioned, The distribution of funds between stocks and bonds is an investor's most crucial choice. Thanks to much historical data, we know the long-term behavior of various stock and bond allocations. 100% bond portfolio. Based on data from 1926 to 2018, Vanguard provides information on several portfolio allocation methodologies' historical risk and return. For instance, a bond portfolio typically generates a 5.3% annual return. 1982 was its greatest year, with a return of 32.6%. In its worst year, 1969, it plummeted 8.1%. 14 out of the 93 years of historical data presented by Vanguard saw a value loss for 100% bond portfolios. 100% stock portfolio. On the other hand, an all-stock portfolio had an average yearly return of 10.1%. 1933 was the greatest year, with a 54.2% return. Its worst year, 1931, just 2 years earlier, saw a decrease of 43.1%. Vanguard's investigation covered 93 years, during which the portfolio lost value 26 times. The differences between these two extreme portfolios highlight the benefits and drawbacks of bond and equity investments. Long-term returns from stocks are far higher, but the stock-only portfolio had much higher volatility. Investors must decide how much volatility they can take while also considering the returns required to achieve their financial objectives. Models for asset allocation based on income, balance, and growth. We can categorize asset allocation models into 3 major categories: income portfolios, which contain 70% to 100% of bonds; balanced portfolios, which contain 40% to 60% of equities; and growth portfolios, which contain 70% to 100% of stocks. A growth portfolio is typically advised for investors who plan to retire after a long career. Regardless of the asset allocation model you select, it would help if you decided how to put it into practice. We'll look at 3 simple asset allocation portfolios in the following section, which you can use to build an income, balanced, or growth portfolio. 3 portfolios for easy asset allocation. One could build various asset allocation portfolios to carry out an investment strategy. Here, we'll keep it simple and examine 3 fundamental strategies. Although their complexity rises, they are all fairly easy to implement. The one fund portfolio. With just one target date fund, you can put an asset allocation strategy into practice. Most 401k plans have target date retirement funds for 2 crucial purposes. They start by distributing an investor's funds among various diverse mutual funds. Bonds and stocks are both investments in these funds. They often include holdings in domestic and foreign stocks, bonds, and small and large cap firms. Second, the target date retirement fund gradually changes its asset allocation in favor of fixed income securities like bonds as an investor approaches retirement. This lessens the portfolio's volatility as the investor approaches the point at which the portfolio will increasingly be relied upon to pay for retirement living expenditures. Target date funds are typically categorized according to the year the investor intends to retire. For instance, an investor anticipating retiring in around 35 years may opt for the Vanguard Target Retirement 2055 Fund, VFFVX. This fund invests in U.S. and foreign bond funds and U.S. and foreign stock mutual funds. Its asset allocation approach currently has about 90% stocks, 10% bonds, and short-term cash reserves. Of course, as we approach closer to 2055, this allocation will start to tilt toward bonds. When thinking about target date funds, bear the following 3 things in mind. Fees for target date funds can be very high. Vanguard's target date retirement funds are inexpensive, while some mutual fund providers charge more than 50 basis points. A taxable account might not be a good fit for target date funds. Target date retirement funds might not be the best choice for a taxable investment account because they contain bonds and other fixed income instruments. Putting money into a target date fund corresponding to the year you intend to retire is unnecessary. Regardless of the year you intend to retire, you can discover a target date retirement fund that follows your preferred asset allocation strategy. The two-fund portfolio. Consider a two-fund strategy if you want more control over your asset allocation. You may build a strong investment portfolio using just two diversified index funds. You may, for instance, invest your stock allocation in a total market index fund that includes domestic and foreign corporations. The portion designated for bonds might subsequently be added to an index fund that holds all bonds. The stock-bond allocation you like can be implemented simply with this portfolio. As an illustration, here are two Vanguard mutual funds that might be used to create a two-fund portfolio. Vanguard Total World Stock Index Fund, VTWAX, and Vanguard Total Bond Market Index Fund, VBTLX. Such a portfolio might not appear to offer enough diversification at first look. However, the Vanguard Total World Stock Index Fund invests in over 8,400 firms. These businesses also have headquarters throughout the world. The Vanguard Total Bond Market Index Fund buys more than 9,000 bonds. In other words, even this two-fund portfolio has many investments. The three-fund portfolio. Consider a three-fund portfolio if you want even more control over your allocation. In this hypothetical portfolio, the stock allocation is split between mutual funds, one investing in U.S. stocks and the other in foreign stocks. This gives investors more influence over how much of their stock allocation goes to American companies and how much goes to companies abroad. The Vanguard Total Stock Market Index Fund, VTSAX, Vanguard Total International Stock Index Fund, VTIAX, and Vanguard Total Bond Market Index Fund, VBTLX, are three mutual funds that could be used to implement the three-fund strategy. Other mutual fund companies offer similar index funds and can be utilized to implement the three-fund strategy. Fidelity offers a variety of index funds, including the Fidelity Zero Total Market Index Fund, FZROX, the Fidelity Zero International Index Fund, FZILX, and the Fidelity U.S. Bond Index Fund, FXNAX. Most significant mutual fund providers have comparable target date retirement funds and index funds that can be used to construct any of the three portfolios above. Pay attention to fees. Keep investment costs in mind as you choose your asset allocation plan and put it into practice. For a lifetime of investing, a fee as small as 50 basis points might lower your returns. Generally, try to reduce your investment costs to a maximum of 25 basis points. Ideally, keep them to less than 10 basis points. Building wealth with dollar cost averaging. One of the easiest methods for increasing returns without increasing risk is dollar cost averaging, which is also an excellent way to learn buy and hold investing. For those who desire to set up their investments and deal with them occasionally, dollar cost averaging is even preferable. It's one of the most effective and easy investing methods, perfect for novice investors. Here are the definition and applications of dollar cost averaging for maximizing investment returns. What is dollar cost averaging? Investing a sum of money into a portfolio regularly, usually monthly or biweekly, is known as dollar cost averaging. By increasing your savings with each paycheck if you have a 401k retirement plan, you are already using dollar cost averaging techniques. Timing the market is the practice of investing all of your money at once, and it can be risky if you invest when a stock reaches its high point, risking a significant loss if the stock falls from there. By doing this over time, you're dispersing buy points and avoiding this practice. You'll be purchasing over time and averaging your purchase prices if you use dollar cost averaging. Dollar cost averaging allows you to profit from a choppy market. Regularly adding funds will allow you to buy when the market is weaker, lowering your average purchase price and resulting in the acquisition of more shares. Your regular payment will purchase fewer shares when the market rises, but you will already have shares from earlier purchases, so you will still profit and won't completely miss out. Dollar cost averaging can also have other advantages. People stop buying stocks when they become affordable because of anxiety when equities decline and to prevent further short-term losses. Establishing a consistent buying schedule when the markets, and you, are calm will help you avoid this psychological bias and profit from stock price declines when other investors start to get nervous. If you reinvest your dividends, the dollar cost averaging technique is also applied to those quarterly dividend payouts, allowing you to accumulate even more shares. Over time, you'll convert your cash dividends into more shares of stock, and once the program is in place, you won't need to do anything. You'll eventually begin receiving dividends on your dividends. A reinvestment strategy can be set up quickly up front. Then you put it on autopilot and delegate the rest to your broker. And that's ideal for loan investors who want to deal with their money as quickly as possible. Dollar cost averaging example. Consider an employee who puts 10% of their $3,000 monthly salary in an S&P 500 index fund through their 401k plan. This individual receives $3,000 each month. The number of shares acquired varies monthly due to changes in the fund's price, but $300 is always invested. Despite the fund only growing, the value of the employee's investments on their $3,000 total contribution will increase by a little percentage. The employee can take advantage of market volatility by purchasing more shares at lower prices. Is dollar cost averaging effective? Depending on your circumstances, dollar cost averaging may be a good investment strategy, whether you should plan your purchases based on market conditions or use the dollar cost averaging strategy to make regular purchases over time. Most people are better off with a steady investment strategy because it has proved exceedingly difficult to time the market. Another problem is that most people invest their money as they earn it, often through a 401k at work. Because you're investing what you can as soon as money becomes available to invest, dollar cost averaging makes sense in this situation. However, you wouldn't want to spread out a huge inheritance, say $100,000, to be invested over several years. The best action in that situation is to invest the money fairly immediately, though you may still stretch out your purchases over a few months to benefit from potential volatility. Dollar cost averaging drawbacks. The biggest drawback of dollar cost averaging is that you'll probably be better off being fully invested as soon as you can in a market that typically increases over time. However, dollar cost averaging is the second best choice because most people save and invest as they earn. It would help if you still chose solid underlying investments, which is a drawback. The method of your first investment wouldn't help if you were to dollar cost average into a bad investment. The strategy functions well with broad-based funds with strong long-term performance, such as an S&P 500 index fund. How to dollar cost average. You can manually set up a dollar cost averaging for your account or have it done automatically. If you select the manual method, you will choose a regular day, monthly, bi-weekly, etc. Visit your broker, purchase the stock or fund, and then you will be done till the following date. Going the automatic way takes a little more work up front, but is considerably simpler in the long run. Additionally, since you won't need to take any action, it will be easier to keep buying when the market falls. Although setting up your automatic purchases might appear difficult, it's not. Finding brokers with additional features like excellent customer service and educational resources is important because almost any broker may set up an automatic buying plan. Here are the steps to fully automate dollar cost averaging. 1. Decide on an investment. It would help if you first decide what you are purchasing. Do you wish to purchase stocks? Or will you choose a mutual fund or exchange-traded fund, ETF? If you purchase a single stock, it will probably vary more dramatically than a fund will. However, finding a brokerage that enables you to buy stocks automatically could be challenging. If you invest in a fund, it should fluctuate less than a single stock and is more diversified, so you won't be as negatively affected if one particular stock falls sharply. The Standard & Poor's 500 index is the basis for some of the most diversified funds, which less experienced investors typically choose. This index is the benchmark for a broad portfolio of firms and comprises hundreds of companies from all major industries. Here are some of the best options for purchasing an S&P index fund. In either scenario, you must take note of the security's ticker symbol, which is the abbreviated name for the stock or fund. 2. Speak with your broker. So, you've chosen your investment. Try to set up an automated buy plan for that investment with your broker now. If you can, you are prepared to proceed to the next action. However, some brokers only permit you to set up an automated plan with mutual funds. If so, you should consider opening a different brokerage account that gives you complete freedom. Multiple brokerage accounts also have other significant benefits, and you can typically receive a lot of value from having multiple accounts. 3. Estimate your financial capacity. Now that you have a broker who can carry out your automatic trading strategy, it's time to determine your monthly investment capacity. You should be able to leave your money in an investment for at least 3 to 5 years with any form of stock or fund. Try giving the investment time to grow and overcome temporary price losses, because stocks can change greatly over short periods. You will therefore need to be able to survive solely off of your cash reserves at that time. Calculate your investment budget, starting with your monthly budget. How much money can you invest once you have an emergency fund? It's crucial to start contributing regularly, even if the amount is small initially. Dollar cost averaging is now more affordable than ever because all major brokers no longer charge commissions for trading stocks and ETFs, and the finest mutual fund brokers let you save fees for thousands of mutual funds. This proves that you can start building your nest egg with any amount of money. 4. Plan your automatic strategy. You can set up an automatic trading plan with your broker using the ticker symbol for the stock or fund, the amount you regularly buy, and the frequency with which you want the trade to execute. Although each broker has a different setup procedure, you will need these fundamentals. Your broker can assist you if you have any other inquiries. Additionally, if your stock or fund pays dividends, now may be a good time to have your broker set up automatic dividend reinvestment. Any cash dividend will be used to acquire new shares, and you can always buy fractional shares, putting the entire dividend value to work instead of letting it sit in cash for a long time, generating minimal or no interest. Your dividend will also continue to generate dividends even after the following dividend. Dollar cost averaging is a straightforward strategy that uses a volatile stock market to help lower risk and boost returns. You can sit back and pursue your passions rather than invest time if you register your brokerage account to purchase stocks or funds automatically and regularly. In investing, you can always achieve better outcomes with less work. The role of rebalancing in index fund investing. Your portfolio may become unbalanced due to market volatility and the type of investments you have. Your response to this will either keep your portfolio in line with your long-term goals or put your future at unneeded risk. Here, we describe portfolio rebalancing, when to use it, and its many advantages. It can be challenging to choose whether to make adjustments and when to leave things alone due to market ups and downs. A systematic rebalancing strategy, however, can be useful. So, you will like this chapter if you want to discover how to invest wiser without working harder. Rebalancing portfolio. What is it? Rebalancing your portfolio involves buying and selling pieces to restore the weights of the various asset classes to their original allocations. Additionally, rebalancing can be used to update the weightings of each asset or security class in the portfolio to conform to a new targeted asset allocation if an investor's investment strategy or risk tolerance has changed. Said portfolio rebalancing determines the asset allocation in the portfolio using a weighted average method. Rebalancing primarily entails routine asset purchases or sales to maintain the desired asset allocation level while staying within predetermined risk parameters. To better understand portfolio rebalancing, let's use an illustration. Ritu chooses to have a portfolio asset mix of 50% equities and 50% bonds. Stocks in her portfolio might become worth more if they did well during the period. She can then sell some stocks and put some of the proceeds into bonds to ensure the portfolio structure stays aligned with her long-term 50-50 goal. When should an investor rebalance a portfolio? Most investors create their investment plans with the long term in mind. However, there may be circumstances where they must reevaluate the makeup of their portfolios and choose to rebalance them. Here are a few instances that demonstrate when it is appropriate to rebalance a portfolio: a change in the investor's risk tolerance, the impending achievement of a financial goal, or the investor's impending retirement. A portfolio's asset allocation can be restored by rebalancing if an investor's investment objectives, time horizons, or level of risk tolerance change. It's crucial to remember that changing asset allocation does not always result in higher yields or insurance against potential future losses. Portfolio rebalancing. How does it work? Let's assume that your portfolio's equities have appreciated due to the stock market changes over the past 3 years. If the current level exceeds the investor's risk tolerance, portfolio rebalancing allows them to return to the original allocation. How can an investor accomplish this? Generally, there are 3 major ways to rebalance a portfolio. However, none of these can ensure profits. Investors must select the best rebalancing strategy. Rebalancing regularly. Investors can pick a day and time to check in on their holdings. A yearly review of investments is recommended. Regular rebalancing takes little time from the investor and can help develop some discipline. A downside to this strategy is that investors can pass up fantastic market chances to rebalance their portfolio. Tolerance band rebalancing. Rebalancing within a tolerance band tries to bring an investor's asset allocation back in line with the original asset allocation based on the asset's percentage deviation. Typically, investors can set a 5% threshold before rebalancing and monitor deviation. For instance, Smriti placed 40% of her money in bonds and 30% in blue chips, mid caps, and small caps. Each asset class's tolerance ceiling is set at plus or minus 5%. If the holdings go outside the tolerance range, Miss Smriti will rebalance the portfolio to restore it to its original composition. Investing fresh money. By using this method, the investor can increase the portfolio size in place of completing a portfolio rebalance and selling high-performing assets. In other words, the investor can add cash to the necessary asset class to preserve a specific asset allocation. How often should your portfolio be rebalanced? Some investors, who are day traders, review their portfolios daily. Although not necessary for everyone, this does not imply that the portfolio shouldn't be monitored. It's crucial to assess the success of the portfolio regularly. Here are some suggestions for those who are debating if they ought to think about rebalancing their portfolios. Investors who invest primarily in stocks, bonds, mutual funds, ETFs, and other similar securities should rebalance their portfolios at least once a year. To avoid being caught off guard when you need your finances most, consider rebalancing more often, half-yearly or quarterly, if you are getting closer to your goal. Advantages of portfolio rebalancing. The following are some of the main advantages of portfolio rebalancing. Controlling risks. Rebalancing your portfolio allows you to control your risks effectively. Risk tolerance and investment returns may occasionally meet or exceed expectations throughout any investment time horizon. Investors can adjust asset allocation and keep risks within acceptable bounds by regularly monitoring portfolios. Reducing losses. Investments can be synchronized with market changes by routine rebalancing, which can reduce losses. The goal is to switch from underperforming and losing investments to those with higher prospects. Investors might be able to minimize losses if they do this promptly. However, it takes ongoing observation and some level of competence to spot these changes. Does rebalancing a portfolio have a price tag? Depending on the frequency and size of the adjustments, rebalancing a portfolio might be expensive for an investor. Investors should be aware of the following fees associated with rebalancing their portfolios. For investors that include stocks and bonds in their portfolio, rebalancing often entails paying the Securities Transaction Tax, STT, as well as the cost of brokerage. These are applicable when buying or selling such securities. If completed within a certain window after the start date, 2% exit load fees are applied to mutual funds for sale transactions. Depending on how long you invested, short-term and long-term capital gains apply when selling equity or debt mutual funds. Investors who view asset allocation as crucial to achieving actual returns must periodically rebalance their portfolios. Although portfolio distribution may appear complicated initially, it is rather straightforward, especially after an investor understands the portfolio architecture and related risk-return setup. How can your portfolio be rebalanced? The notion is that each investment should be tied to a specific financial goal when you spread your money over multiple mutual funds. This will ensure you stay committed and on schedule to reach that financial goal. Therefore, keep in mind to make the changes across all asset classes at once when beginning a portfolio rebalancing activity due to the change in risk profile. Here are 5 easy methods for rebalancing your portfolio. Step 1. Have an asset allocation plan or framework created after considering your income, anticipated retirement age, risk tolerance, etc. Consult a financial expert if you're unclear on how to proceed. Spend as much time as necessary to gather all the information to produce the strategy comprehensively. Step 2. Determine where and how your present investments are allocated across stocks, cash, bonds, to determine your current asset allocation. Compare the desired asset allocation and its current situation after that. Take appropriate corrective action. Step 3. Develop a rebalancing strategy if your goal asset allocation does not match your portfolio. Choosing which securities to keep and in what number during this step might be challenging. Here, a consultant will be quite beneficial. Step 4. Consider the tax ramifications, particularly about capital gains. Holding onto your stocks for over a year will help you avoid paying short-term capital gains taxes. For debt funds, short-term capital gains will be subject to taxes based on a person's income tax bracket. The indexation rate for the tax on long-term capital gains is 20%. Aim to sell the securities in the tax-exempt accounts first to reduce spending. You can reduce the capital gains taxes you pay in this way. Step 5. Evaluate your position in your portfolio at least once a year, but only rebalance it if your allocation seriously impedes your ability to meet your goals. To sum up, rebalancing a portfolio involves finding and implementing a strategy that works best for you as an investor. It must never just be about copying what is successful for someone else. It also involves reviewing and making wise improvements while considering the tax and other repercussions. Conclusion. I love index funds, particularly for novice investors or those wanting to take a hands-off approach to investing. Know an index fund, how it typically works, what it tracks, and the advantages and disadvantages. From there, ensure you're purchasing funds aligning with your financial aims and ambitions. Avoid picking funds at random just because someone instructed you to. Investing in index funds is an excellent method to spread your portfolio without taking on too much risk. It's also a means to invest in certain businesses and access various markets across numerous sectors. Investing in an index fund, which is fairly passive but produces high returns over time, can be a fantastic approach. Start by following these steps to invest in index funds, considering your short and long-term goals and total costs.
We appreciate you tuning in to one of our captivating audiobooks. For more immersive experiences, here is another audiobook we're certain you'll enjoy. Don't forget to show your support by liking this video, sharing what you loved about this audiobook in the comments section below, and subscribing for more captivating audiobooks like this. Thanks for being a part of our audiobook community.